Welcome to The Explainer. We're the show that breaks down really big, complex topics into ideas that, actually make sense.
So what on earth can a lemonade stand teach you about Wall Street? Well, it turns out a lot. Today, we're diving into this brilliant analogy from finance expert Bill Ackman to pull back the curtain on business and investing, starting with something we all get.
All right, let's get into it. We're going to build a business right now, from scratch. Let's say we want to open a lemonade stand, but we have a tiny problem. We're broke. So step one, we got to raise some cash. To get off the ground, we need money. So what we do is we sell a small piece of our new company. This is called equity. We find a savvy investor, maybe an uncle, who gives us $500 for 500 shares. Now we keep 1,000 shares for ourselves, which means our investor now owns a third of our little lemonade empire.
You know what? $500 isn't quite enough. We need a bit more. So we turn to our other option, debt. We go to a friend and borrow $250, and we promise to pay him back with 10% interest every year. Now, this is just a loan. It doesn't matter if our business succeeds or fails, we have to pay this money back.
Okay, and this slide is super important because it shows the core trade-off here. With debt, the loan, we get to keep 100% ownership of our company, but we're on the hook for that money. With equity, selling that stake, we give up a slice of the ownership pie. But here's the kicker. We never have to pay that money back. It's a fundamental choice between risk and control.
And all of that, the equity and the debt, it gives us this, our very first balance sheet. Think of it like a financial selfie for our company at this exact moment in time. On one side, we've got our assets, the $750 in cash we raised, plus something called goodwill, which is basically the value of our awesome idea. And on the other side, you've got liabilities, the $250 loan and the equity our shareholder owns. And as you can see, both sides have to add up to the same number. They always have to balance.
So here's the deal. Having money in the bank is great, but that's just the start. The real challenge, the whole point of a business, is turning that cash into a profit. So let's see how our lemonade stand actually does in its first year.
All right, this is our income statement. It's like the story of our first year in business. And hey, we brought in $800 in revenue. Not bad, right? But then you have to subtract all your costs, lemons, sugar, cups, paying our helper. That gives us our profit before interest. Then we have to pay the interest on that loan from our friend. And when we do the final math,
we lost $15. Yep, all that work, and we ended our first year in the red. It's not a huge number, but it's a loss. And this brings up a huge question for any new business owner. After seeing that negative number, your first instinct might be to just quit, right? Game over. And honestly, most people would. But this is where having an investor's mindset completely changes the game. What if, instead of giving up, we look to the future and reinvest every single cent we make back into the business? And this is where the magic happens. This is the power of reinvesting. So in year 2, we take our cash and we add a second stand. Then by year 3, we've got more stands, we've got a bit of a brand, so we can raise our prices just a little bit. And pretty soon, the growth just starts to feed on itself. It becomes exponential. And check this out. This is the payoff. By the 5th year, our little stand that started with a $15 loss is now a chain of 7 stands, and it's kicking off $1,500 in profit every single year. That is the incredible power of scaling a business. So, the business is a certified hit. It's a huge success. But there's a little catch. The founder, us, we haven't actually made any personal money yet. Every single dollar has gone right back into growing the company. So, how do we finally get paid? Well, we basically have 3 choices. 1, we could start paying ourselves dividends out of the profits, but that would really slow down the company's growth. 2, we could just sell the whole thing, but then we'd miss out on all the future profits. Or there's a third option. We could sell just a small piece of the business to the public. And that third option is called an IPO, or Initial Public Offering. This is where you take your private company and sell shares on the stock market. It lets the founder, us, cash out some of our hard work while still keeping control of the company and getting to ride the wave of its future growth. It really can be the best of both worlds. Okay, so let's zoom out. The whole reason we went through that lemonade stand story is to get you to make a mental shift. It's to get you to stop thinking like a stock trader, watching tickers go up and down, and to start thinking like a business owner. The absolute most important idea from this whole thing is compounding. It's the exact same engine that grew our lemonade stand. It's just this idea of earning a return not just on your initial investment, but on all the returns that have piled up over the years. I mean, Albert Einstein himself supposedly called it one of the most powerful forces in the universe.
And if you think that's just a cool theory, the numbers are absolutely mind-bending. A single, one-time investment of $10,000, if it earns about 10% a year, could grow to over $600,000 in 43 years, and that's without you adding another dime. It just goes to show you that time is your greatest weapon as an investor.
So, the billion-dollar question is, how do you find companies that can do this? Well, Ackman says you should look for what he calls forever businesses. First, only invest in companies you can actually understand and explain. Second, look for businesses that are durable. They've been around a long time and will probably be around for decades more. Think about companies with low debt. And finally, look for ones that have strong barriers that make it really, really hard for a competitor to come in and steal their business.
And this whole strategy really just boils down to the legendary advice from Warren Buffett. Your number one goal isn't to hit a home run and find the next big thing overnight. The real secret to getting wealthy over the long run is simple to not lose money. Avoid those big mistakes, and let the magic of compounding do all the heavy lifting for you.
So here's the big takeaway. It's all about shifting your perspective. Stop looking at flashing stock prices on a screen and start looking at the real businesses behind them. The best investment opportunities, the ones that you can really understand, are often hiding in plain sight. They're the brands you use and trust every single day. So the real question is, what are they?